Welcome everyone to this Story Trading Weekly Meetup, January 17th, 2021. If you can just hear me, I'm using a totally new computer setup. If someone can throw a chat in there, make sure you can hear my voice.
Yes,
or
we can hear you.
One of the admins will just let me know that my mic's working. I'm gonna assume it is. So before we get started, thank you, Ben. Before we get started, just want to throw up this disclaimer and want to note that Story Trading is not an investment advisor. I am not, none of our speakers are unless they say otherwise. Investing in securities involves significant risk of loss. We are recording parts of this presentation wherever indicated. We're recording now. Parts of this recording may be posted on social media. Before we get started, for anyone who's new we're doing a free preview tonight for people who are not part of the VIP community. So what does Story Trading do? We aim to level the playing field with Wall Street insiders through Crowdsourced collaboration. We uncover the hidden story behind the trade and access to management through these Zoom events that we have. And we do that in WhatsApp chat rooms right now and also on these Zoom events. We're actually building our own app to bring a better feature set and scale our business a little bit better. So we're aiming for a July release for our initial release of our app. Tonight's agenda, we're going to go through the featured presentation, which is going to be by Gary Zigmond of Digico Capital on investing in Bitcoin. We'll do our Trade of the Week competition after that, including going over last week's winners. We'll get an update on how the Trade of the Month picks are doing, and we'll choose new picks for this week. Stay tuned for at the end of the session. If you're not a VIP member yet, we're going to give you a special offer how to sign up for this. And plus our agenda coming up, we've got a bunch of programs. Ben, you wanna, or Steven, whoever put this this week's update for the performance review, if you wanna, actually, I just wanna note here, actually we'll do a little different this week because this is a free preview. We've actually blurred out the names of our top winners over here. You can see the returns are absolutely incredible. There was one that was closed out, INTZ, up 175%. That was presented by Aaron. The average return is 61% with an average holding period of just 4 months. So if you want to get involved and hear about these picks, definitely become a VIP member. And with that, Steven,
if you want to jump back, I could talk to the slide a little.
Our special guest tonight.
Yeah, the guest tonight is my dad, Gary Zigmond. He's the founder and chief investment officer of Digico Capital, a cryptocurrency hedge fund.
Hi, let me just share my screen here.
All right, I don't hear Steven. So let's just
jump
over. We got Gary Zigman from Digico Capital.
Hi.
If
I just need to be able to share my screen.
Okay. All right, I hear you now, Gary.
Yeah.
So hold on. You should be able to share your screen now.
Okay, I think we're good.
Great. I had some audio problems, but I hear everyone now. Thank you, Gary, for joining us tonight.
Great, no problem. Okay, I am an investment advisor, but this presentation is just for educational purposes today. I'm not selling any products. I entered the crypto space in 2017 after 20 plus years managing portfolios and risk in traditional asset classes for some of the larger hedge funds. My background covers both fundamental and technical analysis as well as quantitative strategies. And I also was a risk manager for a large multi-strategy fund, which has served me well in the crypto space because the volatility, you really have to manage risk more than anything else. It's easy to make money, but like anything else, you can lose it just as quickly. I'm attracted to crypto really for at the macro level is you're betting on technology. And the way I see it is technology continues to improve. We continue to automate more, regardless of what my opinion or anyone else's opinion may be. We continue to, on that front. And I believe with blockchain technology, that will eventually become part of our economy and our everyday lives. There's been friction for adoption in terms of blockchain technology, just because when you think about it, there are a lot of middlemen in every activity that we engage in. So they're kind of fighting tooth and nail to prevent automation. But I think eventually it will hit critical mass. So right now, the crypto space is more retail driven, although recently, within the last year, we've gotten more institutional players in the space, but it's still by and large a retail asset class. But I think that'll change sooner than later. And I think one of the attractions of the early crypto investors was that it's a decentralized platform. So you're not trusting Wall Street to manage your custody and to execute. And you can think of there are many use cases where a decentralized trustless system has value, especially after last year between healthcare and voting. There's plenty of reason to look for something that's you're trusting technology, and there's more transparency than the opaqueness that we've lived through the last year. One analogy I usually make with crypto investing is it's early stage investing. And so it's very analogous to venture capital investing, where there's a lot of upside potential and a lot of risk just because it's unproven. A lot of the coins, they're use cases, but they really haven't been used. Other than Bitcoin, it's questionable. A lot of the 2,000 plus coins, how much value there really is. So at the end, it tends to be more of a gambling casino. Bitcoin certainly has value. I think initially when it was released 12 years ago, the idea was that it would be more of a currency or a replacement for the fiat currencies. However, I think it quickly morphed more towards digital gold, just because people started to realize the scarcity component, and that's not inflationary like most currencies are. So that's where it stands, and that's why it's valued, almost at 40,000 these days, because of that scarcity component. And when you think about it, I know your group is typically investing in equities and stocks, doing fundamental research, and possibly some technical analysis. Crypto, until you have the fundamental underpinning, until blockchain is really part of companies' bottom lines, the economy, and our daily lives, we don't have the fundamental underpinning. Bitcoin is priced at 36,000. It could be 360,000. It could be $3. You can make any case on the fundamentals because there's really nothing driving it fundamentally. So it is closer to commodities or FX, where it's more flow driven, and it's very trendy. So that's why it's hard to compare it to equities. Even looking at market caps, it's not the same. And that's why I do think that an approach that's closer to a commodity or FX approach works. So some technicals may work, but I'm not a huge fan of technicals in that they're not as repeatable, and you don't have the repeatable edge that I would like to see as a professional investor. Just to review the asset class quickly, back in 2017, you had the huge move, and that was all the retail FOMO, where basically it was consciousness across the globe. People were just first getting into Bitcoin. And then 2018, the bubble burst in terms of it was, hypes. You were expecting institutions to get in with the advent of crypto futures. It didn't quite happen, as there's still a lot of hurdles to overcome. People were expecting ETFs, and that's still probably a distance away, probably another 1 to 2 years away for a Bitcoin ETF. 2019, you had a bounce back. Bitcoin almost doubled. Where there was a lot of improvement on the infrastructure. A lot of players, bigger players entered. The Fidelities started entering, and there was improvement. Although that year was pretty much Bitcoin, most of the altcoins did not perform anywhere near Bitcoin. And then last year, once we got through the first quarter, through the COVID, the initial reaction to COVID, it was off to the races for Bitcoin, and 3x move. And that's where you're finally seeing institutions dipping their toes in. There's one product, there's a Grayscale Bitcoin Trust. And that's as close as you can get to an ETF, where they started the year 2020 with 2 billion in assets, and they grew up to 20 billion by the end of the year. So it was a 10x, increase in AUM. And that's largely institutions. I think the average holding is about $7 million. So you are seeing, interest in the space. And the interesting thing when you look at that product is the last 10 weeks of the year, they grew assets by 3 billion. Meanwhile, the gold ETF lost 7 billion over the same period. So you are seeing a shift from some of the traditional gold bugs dipping into Bitcoin, and more millennials using it as your macro hedge, your inflation hedge, especially with all the central bank printing that went on this year or last year. You do see that crypto's benefiting, especially Bitcoin. Big thing with the high volatility in the asset class is you really have to come in with an approach of how to manage that volatility. Otherwise, you'll get easily blown out of the water. Annual vol of 70 to 100%. It's hard for many people to really wrap their arms around. So let's compare it to something you're familiar with. Equities, the VIX, it's typically 10 to 20%. You only reach those high levels, up to 100% during crisis. And that's basically what you're dealing with every day in and day out with crypto. So if you don't have a plan, then losses are basically statistically guaranteed. And you'll see later as I present drawdowns each year, even in bullish years, you do see significant losses. So you have to have an approach to either you size it very small or you take more of an active management approach. And that's, I'm listing 3 ways that you can manage your volatility or risk, which is sizing that passive exposure to a very small level so you can sleep at night. Following, I'll introduce a basic active management. Some of you guys as technical analysts may appreciate that. It's just a simple moving average strategy. And then finally, a more refined active management strategy, which is what Digico uses. I'll give you a glimpse of what we do. So a small allocation to manage the volatility and benefit, even if you only allocated, say, 2% to Bitcoin. If you roll back the tape and say during 2017, a 2% allocation would impact your portfolio by 27%, gooses your returns. And even the crypto winter of 2018, where the asset class lost 3/4 of its value, using a 2% allocation, you only lose 1.5%. 2019, you pick that back up, and then 2020, you're getting a 6% boost to return. So it is very additive from a portfolio diversification perspective. It doesn't take much, and it's funny because you had the naysayers a few years ago saying, "Oh, Bitcoin won't last. It's it's just a casino. It's as Warren Buffett said, rat poison." But each year that passes, it's not going away. So there's value there, and people appreciate it. I think in the United States, it has a much a worse reputation than around the globe, where certain freedoms, especially when it comes to your currency, we're very spoiled with the dollar in that it's the global currency. It drives the petro commodities. Everything's priced in dollars, and there's stability, and also it's it holds its value, whereas other currencies don't offer the same features as the hard currencies of, say the top 5 currencies. So there are other uses that people appreciate for Bitcoin that we as Americans probably take for granted. Now, as a former risk manager, I like to look at drawdowns, and I measure, drawdown is really just your loss from the last high. And that really gives you a good idea of the pain that you have to live with, because it is rarely a straight line to new highs. And I like to call it dead money, because it's periods when you're in drawdown, you're not making money, so it's your investment is dead money. And so I just want to go over the math just briefly. If you can keep your drawdowns low, then you're going to lessen the pain. So a 10% drawdown, you only need 11%, recovery to overcome that drawdown. 20% is 25, 30. So now it starts getting, little harder. You get to 30%, you need 40%, 33% move. And once you hit that 50% threshold, you need to double your money. So that's where, if you can keep those drawdowns, say, south of 30%, definitely south of 50%, it's going to be much easier to recover. And you'll see now, if you're just a passive investor in Bitcoin, even in a year like 2017 was extremely bullish, you did encounter 3 periods of drawdowns of over 30%. Fortunately, the recovery was very quick. Within 2 months, you were back at new highs. However, once you got out of that very bullish phase, the end of 2017, early 2018, you hit the bearish period, and all of a sudden, even a 34% drawdown, it was a bit of a challenge. And then, obviously, 2018, there was really 2 periods. There was a 50% correction the first quarter of the year, and then the last quarter of the year, another 50%. So it took you basically 3 years to get back above water. So that's the challenge with a new asset class, is really timing. It comes down to timing. And if you can dollar cost average, you can figure out ways to lessen that impact of timing, because nobody knows if you're getting in at the local high or the local low. It's too much of a gamble to try to time it. And then 2019 was a mixed bag, where early in the year, the market was up strong, and then it gave back 50%. So once again, a 50% drawdown, which took you over a year to overcome. And then even this year, when you had your 50% correction off of COVID, it still took 6 months to overcome that drawdown. So that's the problem with passive investing, is you're not controlling the drawdowns. You're just going along for the ride. So it's the roller coaster up and the roller coaster down. So the second way of managing that volatility is through active management. So as I mentioned earlier, if you take use a simple 50-day moving average of prices, and you stay long once you're above the moving average, and then you go flat when you're below. So let's take a look and see what that looks like. So in 2017, see the green is the shaded. That represents when you're exposed, when you have exposure on, you're above the 50-day. And then the white sections are where you're on the sidelines because it's below the 50-day. So you see, in general, you're catching the moves, and then the few drawdowns in 2017, you're sidestepping some of it, but you're catching the large moves, which is really what you want to do. So your average exposure is 88. So 88% of the time you're in the market, which makes sense because it was such a bullish year. In 2018, the flip side, when it was bearish all year, you're only in the market, less than 20% of the time, but you were catching, some of the moves you were catching. So more than anything else, it's protecting you during the severe corrections. And then 2019, you see that big run up early in the year, you were involved. Yeah, and then in general, you sidestep some of the give back, the carnage. And then this past year, same thing, you were out when there was that COVID correction, and then you got back in, and then the end of the year, you were involved. So that's a nice, simple strategy to be able to compound your returns without taking on too much risk when the market is just very bearish. So here's a summary. So in 2017, you would have made over 500% following that strategy, and you're only trading roughly once a month. You have to engage. So it's not something that you have to monitor all the time. And in 2018, since the market was down so much, you're not going to be able to have a profitable year when you have cards that you dealt cards where it's a loss of 70% on the passive side. But then you make that back in 2019 and more, and then 2020 you pretty much make most of the move on a handful of trades. And now a little more advanced strategy is what we do at Digico, which is we're not just following prices. We actually we utilize over 50 micro strategies, which take small positions in Bitcoin and Ethereum, long or short, based on different data sets that we're looking at. A lot of it's fundamentally driven, some of it's blockchain data, short interest flows, a variety of data sets that's helping us identify quantitatively, is the market, is it set up to be risk on, risk off? So we average about 150 to nearly 200 trades a year. So it's very active, and you'll see with the next chart how it's not just, hey, all in or stepping on the sidelines. It's small adjustments in exposure based on different data sets that have strategies firing independently of each other, and it works together as a portfolio. And there are occasions where we do go short. The red is where we're net short. It takes a lot for that to happen. Obviously, in 2017, it was so bullish, there's no reason to be short. Whereas 2018, we were short for a few days or weeks at a time. But in general, it's meant to protect. It's very hard to make money on the short side in any asset class, and crypto too, as volatile as it is. It can be done, but you have to have a totally different approach on the shorts than longs. And then 2019, you see same thing where we're active, and then we cut back exposure. When it's basically we're playing where we have an edge, we're going to put more exposure on, and then that when we don't have an edge, we save our money and wait for the next opportunity. And then 2020, similar as well. So this is a comparison of all three strategies, just the passive Bitcoin, the 50-day moving average, and then our strategy. And you really see the power of compounding and what losses, really how they can hurt you and set you back. It's interesting to see that the passive strategy and the 50-day, you're hitting roughly the same endpoint. But you're probably sleeping a lot better at night, not worrying about, I lost 3/4 of my portfolio in 2018. And then you see the value of not losing money with Digico strategy in 2018, where we had enough strategies that could make money when there was an opportunity. So by not having that losing year, you see how the portfolio can grow. Compounding really is your best friend. And with that, I'm open to questions on anything about the asset class, or you name it.
Great, Gary. Thank you so much. That was one of the most interesting presentations we've ever had. I found a bunch of it really powerful. First of all, I like that slide where you showed the kind of a summary of the reason, the story for the year. That was powerful. That's what we try to do at Story Trading, is tell a story and describe the price action. So I really appreciated that chart. And of course, everything with the drawdowns and how you manage that, that's unbelievable. Really enjoyed that presentation. I'm gonna get started with a couple of questions of my own. And in the meantime, if anyone else has questions, just go ahead, raise your hand or put it in the chat. What I wanted to start with was that ETF, GBTC. I heard there's a new one coming out, maybe this week even, OBTC. Do you know anything about that? And is one better than the other, if you do know something about that?
I'm not familiar with that. There's quite a few similar to GBTC for types of investors. I think the interesting thing is a year like 2019, where Bitcoin basically doubled, up 92%. If you would have told me that at the beginning of 2019, I would have expected, institutions have entered the space. And there were quite a few alternatives to GBTC, index products and other varieties that with GBTC, I forgot to mention, there's a premium associated with it. Typically it trades at a 20+ % premium. So it's a closed-end fund, closed-end trust. And basically when you purchase it, you're paying 20% over, the cash price, the current Bitcoin price. And you're locked in for 6 months. So once the 6 months is up, you can trade on a secondary market. So it's almost like you're trading a private placement. And that's the risk, is that premium collapses or it doesn't keep up, prices go down, you can get locked in with a big loss. I know some of the newer products don't necessarily have that, or aren't closed-end funds, so you don't have the premium that you're paying. But back to my point on 2019, these other products really didn't gather any assets. So GBTC did grow assets in 2019, but nobody took assets away from them. So it was telling me that institutions, even though it was a bad product because you're paying through the nose with the premium, they were still going into GBTC and not these other cheaper products just because structurally they couldn't. So it was like very limited in what a lot of institutional investors can invest in crypto and the types of product, regulatory wise. Yeah, I mean, every day they're trying to push, new groups are trying to introduce ETFs. It's just the SEC, there's too much work to be done on the plumbing and piping to support an ETF. We take a lot for granted, like a gold ETF or you name it, any ETF in the equity space, that they're market makers. There's a consistent market, the pricing mechanisms, is there, and with crypto it gets complicated because all these different crypto exchanges across the globe with different regulatory oversight and comfort level for investors. So it's totally a different animal, and that's where the challenge is. It's definitely a steep learning curve for new investors to get up to speed and get comfortable, because it's getting custody. What do you do? Do you self custody? Do you leave it on an exchange? Do you put it in a cold wallet? There's just so many things to learn for the space. But being early, there's a lot of opportunities. There's a lot of hair on the beast, but it does provide plenty of opportunities for people willing to spend the time.
Great, Gary. That was actually my next question, was in terms of what platforms you invest on. I back a couple of years ago was very involved, and I was trading through like Binance and KuCoin, different apps, which was very hard to deal with. Some of them got banned by the App Store. Other ones you have to use a proxy. It was crazy. So I kind of gave up on that, and I just went the ETF route. Do you recommend for someone who's used to stocks and they're mostly in stocks and are thinking of having a 2% exposure, is it worth it for them to explore these different platforms, or just go the ETF route?
I think a simple way for you as an investor, it's pretty simple. As a retail investor, I would just open up a Coinbase account, because Coinbase is one of the best exchanges, the most regulated in the US, safest. And they actually, most of the assets are stored on a cold wallet. So I think they say over 90%, 95% is on cold wallet. So even though you hear of hacks at some of the, Binance had a hack last year or 2 years ago, Coinbase is kind of like, the higher end in terms of safety and security on the retail side. For institutions, it's still risky leaving it at some of these exchanges, because it's really, when they call themselves exchanges, but it's more like brokers. It's like you're dealing with individual brokers that have quotes that offer liquidity. So it's not the same type of exchange when you think of New York Stock Exchange or NASDAQ. Not the same level of, safety and custody and settlements and everything. But in general, if you want exposure, it's not that hard to get exposure through like a Coinbase. It's when you want to go to like the altcoins, that's when you get to these second or third tier exchanges where it's anybody's guess at how safe their business practices are, because the blockchain has never been hacked. It's when it's on an exchange, you're basically dealing with a database on that exchange where they can hack into that database and steal all the coins. Big honeypot. But if you stick
Great, thank
with
you.
the basics, it's relatively safe.
Okay, great. Rob, you want to take it from here with the rest of the Q&A?
Yeah, so we have several questions in the chat, and also anyone who wants to speak their questions, go click on the participants section on the bottom of the screen, and then to the right of the box that comes up, you can raise your hand and I'll unmute you. But for now, I'll read some of the questions in the chat. From Joey Fry: how much credence do you give to the stock to flow model and predictive models for price based on previous halving cycles?
Well, I mean, the halving is interesting. It's definitely bullish as there's, the inflation rate drops every 4 years, drops in half. In terms of trying to put valuation on this, I guess from a long-term perspective, there may be some credibility in like a stock to flow model. But in terms of, it's not going to help you day to day or week to week manage your exposure. And that's where I just look at it more, even the way we approach it at Digico, we're not trying to predict prices. All we're trying to identify is emerging trends and saying, okay, is this trend based on the data we're looking at, does it look like it has legs? We'll put exposure on, and then the first sign based on the data, it changes, we'll take off that exposure. And typically that's very active management, as you saw over 150 trades a year. That's expensive in most asset classes. With crypto, that's actually a positive because of the volatility, and we're constantly adjusting our exposure. We're avoiding it. It's expensive to trade, but we can avoid some major givebacks. I just think it's still way too early to use any of these models and be comfortable. I think the problem with a lot of times with models is people get too complacent with them and they put too much faith behind them. It's still too early for the asset class. You still don't have all the participants you're used to having in other asset classes. So that's also why it's uncorrelated, because you have a small subset of the investor base of any other asset class.
Sounds good.
We're still willing to look at, explore any of these valuation models. It's just, it's a hybrid asset class. So it's hard to apply valuations for commodities, for currencies to this asset class.
Okay, and the next question, you answered part of it from Stephen F. What exchange do you recommend retail investors to buy, sell Bitcoin for the best execution and commission? Coinbase seems expensive when you take into account their spread and commission.
I guess it depends on how comfortable you are. I mean, I place the credibility of the exchange first and foremost, because I never want to lose investor assets because I had a poor credit decision on exchange. As a retail investor, if you're looking for the cheapest, then you could probably find cheaper than Coinbase. It's just Coinbase, I don't think there's going to be a problem getting hacked. Whereas a cheaper exchange, you may have that. So there's always a trade-off. It's just which risk are you comfortable with? And if you're not that active in trading, I don't think the cost is going to be that prohibitive using, say, a Coinbase.
That makes sense.
You have other exchanges like Gemini is a lot more expensive than Coinbase. So Coinbase for sure is not the most expensive. I'd say it's one of the less expensive ones of the reputable exchanges.
Now we have a couple of questions from Sam. What is your view on Bitcoin government regulations? Do you find that a big risk?
It always is, because it's kind of like whack-a-mole. Back in 2017, China outlawed Bitcoin back in like September, October, and there was a mini correction there. That was one of the 30% corrections. But then typically if one country forbids it, then it just opens up opportunities for other countries. I think the biggest risk for Bitcoin to truly go away, you'd need a concerted effort by all countries to say, oh, we're just banning it, which I don't think is going to happen. I think there's a bit of a arbitrage from regulatory perspective to say, okay, this one's more favorable, this one's less favorable. One risk, which I didn't mention, was right now China, they account for about 3/4 of the mining. So mining really provides a security for the network. So if for some reason they ban mining, then in the short term, that would be negative for the price. However, in the long term, those miners would migrate to other countries that are more favorable. Just right now, China is by far the cheapest electricity-wise, and that's why the miners, most of the miners are there. But so far, Bitcoin has survived many, regulatory, hurdles from one country to the next. So I just think it's too global to really squash it.
Okay. And another question from Sam. What is your opinion on lending platforms such as BlockFi and where you earn APY on Bitcoin?
Yeah, that's tricky. So from our perspective, when we need to short, we have strategies that do go short, Bitcoin and Ethereum, we need to borrow. So we're not lending to earn yield. We're actually borrowing so we can short. And typically it's not that expensive. It'll cost us maybe 6% a year to borrow. And we're only borrowing for a few weeks or a month at a time. So it doesn't accumulate till, and it's not the whole portfolio, it's small tranches. On the flip side, the lending, some of this stuff, if they're promising you, annual returns of 10 or 12%, that's not in line with, if I'm paying 6%. So there's something probably fishy going on. I wouldn't necessarily trust the network or the platform. And then there are other coins where they're offering you much higher yields, 20, 30, even higher than that. And that one, you just got to wonder the value of the coin if there's that much inflation going on. So generally, I'm not a fan of the lending platforms because I think they're just trying to earn a lot of interest, but in terms of activity. But at the end of the day, you have to pay for that somehow. So there's either inflation for the coin, or it's like playing hot potato where somebody's left holding the bag. So it just, as a professional investor, I kind of stay away from that because it sounds too easy and too good to be true.
Got it. And then I have a couple questions. One, you talked about Bitcoin as a commodity similar to gold, but the scarcity of Bitcoin is limited to like a set amount, whereas gold can be continually mined. I know Bitcoin could also be mined, but isn't it limited to a certain amount and then it just stops there?
So right now there's 18.5 million, and in another 100 years it's going to go up to 21 million. So every 10 minutes there's 6.25 Bitcoin is mined. And then in 4 years, when the next halving, it'll go down to a little over 3 Bitcoin. So it drops. So yeah, that inflation rate, and I think gold's inflation rate is about 2% a year, provided there's no big find or you don't start mining it, on asteroids. So it is less inflationary than gold. As long as the algorithm, there's no change in the algorithm, but that would take a Herculean effort to change, the number of Bitcoins that can ultimately be mined. So it's scarce. And also, I would say probably about 3.5 million Bitcoin, most people estimate, has been lost over the years. In terms of early on when Bitcoin was worth pennies, people lost their hard drives and they can't access it because they don't have their wallet credentials. So that's also drives the scarcity down. It's less. So instead of 18.5 million, probably closer to 15 million. And then recently you've had a lot of whales, say investors who have more than 100 Bitcoin, which would be about $4 million. They've been, acquiring Bitcoin. So basically taking supply off the market. So that's why you had such a big move from say 10,000 to 40 over the last few months, was because by some estimates you had 10 or 11 million coming off the market into whales, So then you're talking only like 5 or 6 million's been changing hands. That's why it doesn't take much to push it up. So you definitely have that in your favor. That scarcity is the biggest attraction of Bitcoin relative to any other coin out there.
Yeah, that is interesting. So it's similar to gold, but it has much stronger scarcity than gold.
Yeah, well, and gold too. You have your gold bugs like your Peter Schiffs, all the old farts of the world that they've been bullish on gold for decades. I think it's interesting with Bitcoin. You definitely have that age difference where the millennials appreciate Bitcoin. The true gold bugs are never going to shift to Bitcoin. It's just a question of who finds value. I think if you're looking at it as internet money, it could serve as that. There's definitely more challenges to make it more of a currency, but as a digital gold, I think it certainly proved its worth.
So we just have a few more quick questions. One is my last question. You said institutions are nibbling. Does that mean in the next few years, more institutions can pour in on this?
I think so. I think you're only going to see more and more because initially, a few years ago, there was just too much career risk for anybody to get into crypto from a large institution because too many unknowns, too many questions, and the last thing people want, they don't mind giving up. Some of these big institutions don't mind missing out on the early moves for the sake of not losing their job, not being on the front page of the Wall Street Journal saying, "Oh, how did these guys lose? There was a hack and they lost their investors' money." So they're okay waiting. So even though they may have missed out, say this year from 5,000 to 40,000 in 2020, if they truly believe that there's going to be more institutions, it's going to be much higher. Not trying to predict. I mean, I think long term, yes, it goes higher. Who knows how high? But it's basic supply and demand. There's not a lot of supply, and there will be more demand.
Makes sense. And then the last question from Steve Bank. What are your thoughts on investing in Bitcoin mining companies such as Riot, I think Riot Blockchain, Riot and Mara, M-A-R-A?
Yeah, I mean, mining is interesting because that's the, for years ago, even like a year like 2018, when the prices were down, miners were still, making money, but it's tough because it's competition. They're run professionally. So you had exchanges that have made money and miners, and then everyone else in the ecosystem, it's like fits and starts to make money. Mining, I've heard different quotes. I mean, some annualized returns 20 to 30%, but it's tough because it's a constant battle with upgrading your technology, your software and everything, hardware really, to keep up. And then can you locate where electricity is cheap enough? Personally, I think it really depends on what you're looking for. If you're looking for consistent returns, possibly mining, but I think might as well just allocate a small amount to Bitcoin and just play the price appreciation. It's a different approach entirely. It's either you want to benefit from the volatility and the asymmetric risk return profile, or you want something more stable, more consistent, like dividend-like returns. And I think that's what mining can offer.
That was our last question, and thank you so much for presenting. And it's good to hear that Bitcoin is still in early stages and still has a ton of potential. And thank you for all the information.
Oh, my pleasure. Thank you for having me.
Thank you again, Gary. All right, that was an awesome presentation. So let's go on with the rest of our program here. We do have a crypto trading WhatsApp. You can find that link at StoryTrading.com under, I think it's in the trading group section. If you're not in there, you can hop into that group and collaborate on WhatsApp. Now we're going to move into trade of the week now.